We're really lucky in New Zealand with our income tax system. We're one of the only countries in the world where you probably didn't have to do an income tax return last year and enjoy the beautiful, beautiful paperwork that goes with it. Now, the reason for that's pretty simple. Our government is pretty good at the basic ways that you can earn income, making sure that the tax is deducted from it before it hits your back pocket, which is really useful because that means that you don't have to keep records, put the money aside, pay the government, and get involved in all of this really annoying technicalities. Instead, it's taken care of for you. So, it's not to say that you can't submit a tax return. In fact, that's how tax returns that give you money, known as a tax refund, are done, or tax returns where you have to pay the government money are done. So typically that's for people that have got more complicated situations, say for example contractors. But most people don't need to worry about this. So let's look at what makes up income tax in New Zealand, and start with the most simple example, PAYE. So if you're earning income through a salary or wage, you're going to have to pay PAYE. So let's say your employer is paying you money. First you start with your gross payment, that's the total before tax is deducted. PAYE is amount that is deducted from this and sent to the government. And what you receive in your bank account is the net payment, as in net of tax. It's a smaller amount. That means that the tax is paid, goes from the company to the government, without you needing to worry about it. The correct tax rate is used, and we'll get into those later, because when you started your job, you would have had to have told your employer what your tax code is, and that tells them how much to deduct. Now, the same is true if you're on the benefit. You'll also have tax deducted, which it's a bit counterintuitive. You're getting money from the government and the government's taking tax on it, but never mind. The whole principle behind this is a dollar is a dollar is a dollar. Doesn't matter how you earn it, you're taxed on it all the same. So interest, that's one of the other big areas that people have. So if you've got a bank account that earns interest, again, dollar is a dollar, you're going to be paying tax on it. The way this is handled is through residential withholding tax, which means that your bank takes the amount of money that you need to pay in tax and it sends it to the government for you. So you don't have to do that. Now, again, dividends, that's another one. Residential withholding tax. The company that would pay the dividend takes the amount of money that you'd need to pay in tax and it sends it to the government for you. You start to get the message here. But then the question becomes, well, okay, sure, we've got this great system, but how do they send the right amount of money? Well, we've got to go and start with the tax bracket system in New Zealand. So the basic concept is that when you are earning less money, you pay a lower rate of tax compared to when you're earning more money, because the reason why you're able to earn more money is because you're able to take more advantage of the systems that we've got in New Zealand. It's easier when you've got money to create money. So essentially, as you're earning more money, the tax rate goes up. So when we start out and you've got your first $14,000, that is going to be gone and taxed at 10.5%. From your after $14,000 to $48,000, it's taxed at 17.5%. 48,000 to 70,000, it's taxed at 30%. 70,000 to 180,000, it's taxed at 33%. Over 180,000, it's taxed at 39%. So as you can see, it goes up over time, starting at 10.5% for your first 14, up to 39% over $180,000. What that means is that the people that are earning the most money proportionally are paying the most in tax. Well, in theory anyway. So what happens is that when you tell the IRD through your tax code at your job that this is your main source of income, then what they'll do is they'll work out, okay, well, this is what you're going to be paid over a year. This is what your tax bracket is going to be. So this is how much we should be taxing you. But complications come when you're dealing with, say, your second source of income. That's when mistakes can be made. If, say, you're earning more money than you thought, less money than you thought, you're changing jobs, you're finding that your secondary source of income might be not your secondary and instead you're earning more from it. All of these sorts of things can mean that the amount that's deducted from your tax is wrong. That doesn't necessarily mean you're getting a tax refund, though. A tax refund happens when it turns out that you have paid the IRD too much money. However, the error can happen in both directions. So at any point you can submit an IR3, which is a tax return for the tax year. And if it turns out that you owe the IRD money, you're going to have to pay them the money. And you're not going to know until after you submit your tax return. However, if the reverse is true and the IRD owes you money, then the IRD pays you that money. So it's a little bit like going to the casino, I guess, in a way. Typically, people tend to get tax refunds more often than the reverse, but you can't rely on that. Now, I always would recommend to do your IR3 yourself unless things are very complicated, simply because paying, there's organisations out there that are saying, get your free tax return today. Often it's very little paperwork to do your IR3 and they'll take a big cut of the profits potentially. So I don't really like those organisations typically. I really would recommend you just learn how to do it yourself, and we will get into that in future. So this is your basic sort of rundown on how you're able to go and do a tax refund and how this whole system works. There's other areas too, like capital gains tax, for example, which we'll get into in future videos. But remember, the basic principle in New Zealand is income tax. Most people don't have to worry about submitting an income tax return each year. Unlike most countries, because the government takes care of it for you. The money is deducted, your tax, before it hits your back pocket. That's why you often don't see it, you often don't think about it. However, if in doubt, a dollar is a dollar is a dollar is a dollar, and if you're earning money in more weird and wonderful ways, like you're contracting, you're going to have to do an IR3 every year. And you can always choose to submit one if you want to spin the wheel and see, am I going to get a tax refund or am I going to owe money? That is the first part of our series on tax. Stay tuned for further videos.